Welcome everyone to Stockless. Today's video is about the deceiving PE ratio, which is probably one of the most popular and misused valuation metrics in finance. And that's, in my opinion, both among retail and professional investors. After watching this video, I hope you learned the basics of the ratio, how it's constructed, you understand how profitability affects the ratio, and you know how to use it. And with that said, let's get started. So first, the basics. The price to earnings ratio, or PE, is a very common way to value stocks, probably because it's so simple. You just take the company's stock price in the numerator and divide it by the company's earnings per share, which is the denominator. And it tells you how much investors are willing to pay per share for $1 of earnings. Now, there are two common versions of the PE ratio. The first is the trailing PE, where you look backwards and use the past 12 months of earnings as the denominator. The downside here is that stocks are valued based on future expected cash flows and not the past. So you might end up valuing a company based on old data. And if the company has recently changed a lot, or if the numbers are expected to rapidly change, then the data will maybe be old. The second option is to use the forward PE, which uses earnings guidance for the next 12 months as the denominator. And I tend to favor this one because the market and analysts tend to look 6 to 12 months forward, so the price will be more aligned with what the company has recently commented. The downside here, of course, is that you need to be able to trust the company's guidance. And if you're dealing with a bad, unjust, or a very macro-sensitive company, you might get misled into using the PE on the wrong terms. Let's move over to a slightly more advanced understanding of the PE ratio. So what you see here is the mathematical formula for the PE ratio, which consists of two parts. First, 1 divided by R, which is the value of a company without any growth. And then the second part with the letters PVGO and some other stuff, which represents the value of a growing company. Now, while we don't have to go any further with the mathematics, what I want you to notice is that profitability in the form of return on equity, or ROE, is a part of the equation. And that has some serious implications. It means that the PE ratio is not only about growth, but also about how profitable a company is. A short heads up here. In another video coming soon, I'll discuss the difference between return on equity and other profitability metrics, because there are some downside to using this metric over, for example, return on investment capital. So please remember to subscribe to this channel if you want to learn more about that. Anyhow, since profitability is a part of the equation, one could expect that the PE ratio will be different for two companies with equal growth but with different profitability. Maybe it's even fair to say that high profitable, growing companies should and even deserve a high PE. So, with all this information, how do we know what's a reasonable PE to pay for a company? Well, commonly a PE ratio of around 15 to 17, based on historical averages, is considered normal. So if a company is below this range, it's often considered either a no-growth company or undervalued. And if it's above, it's often considered a growth company or overvalued. But that view is too simplistic in my view. So first, the fair PE range depends on the sector of the company, and that has to do with the growth and profitability opportunities. Basically, are investors expecting much earning potential in the long term, or is the company working in a mature or cyclical market with little growth ahead? As you see here, the normal PE range for financials, materials, and energy is normally low, while it's high for technology, healthcare, and consumer staples. And that is because the latter has better profitability, better margin, and are generally stronger long-term plays as earnings compound over time. To illustrate this point, look at the PE ratio of Alphabet, where both earnings, margins, and profitability is very good. Since earnings compound so fast, the denominator in the equation will grow quickly, and hence, what may look expensive this year could quickly turn out to be a bargain if one looks a bit further ahead. In contrast, here's a random energy company. What you may notice is that the PE ratio very slowly goes down, and if we look at the earnings, we understand why. It's not really changing much, which again means that the denominator in the PE equation stays put, and it's showing that investors are not too optimistic about the earnings potential for this business. I hope you learned something by watching this video about the PE ratio, and if you did, please remember to like and subscribe to get more similar content in the future.